So there are a lot of different ways that you can market your painting business, and I've tried most of them. I've done local news, radio, Facebook, Nextdoor, Google AdWords, lawn signs, vehicle wraps, Painter Choice, Yelp, Angie's List, just to name a few. And basically what I found is I've broken marketing down into two different categories. The category that I can quantify and justify, and then the category that I can't. And that's actually the number one issue I see with most painting companies, is that they're not measuring and quantifying their marketing strategies. In order to do this, you just use a CRM. Obviously, I'm gonna recommend mine. If you're not doing this, I would strongly recommend it. I'll put a link down in the description, but get a CRM, hopefully mine, and start using it. But let me explain what I mean by measure and quantify. Let's say that you start buying Angie leads. These are very easy to measure and quantify because you can figure out exactly how many leads did you get, how many estimates did you do, how many jobs did you book, how much revenue did you make from that, what was your average job size, and how much money did you spend. So for this example, to keep things simple, let's say that you spent $1,000 on these leads. And from that $1,000 that you spent, you booked $10,000. You can calculate your return on invested capital, which you're going to take your $1,000 that you invested and divide it by the $10,000 worth of work you generated, which is going to give you 10%. So you can see how this form of marketing is very easy to quantify and justify if you're willing to spend that 10% for marketing. Now, other kind of marketing that's not so easy to do that might be something like a billboard. So in this example, let's say you spend $10,000 on a billboard, put it in the middle of your town or city, and then when people call, you say, hey, how'd you hear about us? And only one person ever said that they heard about us from the billboard, and maybe that turned into a job, maybe it didn't, but you can see how that would be a really bad return on investment. But is that really a bad way to market? The truth is it's really hard to quantify, because something that may have happened is people saw your sign and it started to build brand recognition and gave people confidence that you're not just some fly-by-the-night company, that you're reputable, and maybe even subliminally in their mind, now they know about you. So when you do the estimate, maybe you booked some extra jobs that you wouldn't have booked just because of that billboard, because you seem like a trustworthy company for whatever reason. Maybe they remember they saw the billboard or they didn't. So that's where it gets really hard to quantify. You're never really going to know how many extra jobs did you book due to that brand recognition. Now, I tried to take the extremes of both, but when you market, that's what you're going to find, is that there's going to be marketing that's really easy to measure and figure out what your return on investment is. And there's going to be marketing that there's not. And I'll come back to that in a little bit. So let's talk about how should you market for your business. Now, the first thing you got to do is you got to make a plan. And that plan is going to be made of two different parts. Part one is you need to have a plan, like how many leads do you need, how many estimates you're going to do, how many jobs you're going to book, how many crews do you need, all that kind of stuff. I'll put a video right here. I'll link it to how to hit your painting business goals. It's going to walk you through that process and show you a little bit of how to develop that. The other part of your plan is going to be a financial forecast. Check the links in the description for more information with help on this. I do sell an accounting sheet that basically has a forecast, and it also will allow you to track that sort of thing. But basically all it is, it's going to be a P&L of what you want the next year to look like. So you're going to make a plan, and in that plan, you're going to have a marketing budget. So to keep things simple, let's say that you want to do $100,000 in revenue and you plan to spend $10,000 in marketing over the next 12 months. So your marketing budget is 10%. Now that you know your plan and what your marketing budget is and what you want to spend as a percentage, the next step is going to be write down all the different ways that you can think of marketing, and then pick the winners. Pick the ones that you believe are going to do the best for you and your particular situation, area, and business. And remember, try to pick marketing that you're going to be able to measure and quantify, and make sure you have a plan in place to actually get the data and measure this stuff. So you're going to pick the ones that you're going to want to try, and then the next step is basically just to implement them, to spend money on that marketing, and then track it and figure out what that return on investment is. So let's say that you pick 3, you do them. One comes in at 8%, one comes in at 10%, one comes in at 12%. What you're going to do is cut all the ones that are not within your marketing budget. If they're more, I'm just using 10%. It might not be 10, it might be 5, it might be 20, but I'm just using 10 to keep it simple. It might be 10% is what your plan is and what you're planning on spending for marketing. That one that's costing 12%, you're just going to cut that one out. And then you're going to continue to do the ones that came in equal to or less than that, right? So in this example, there's an 8% one and 10% one. And what you're going to want to do is spend more money on that to help you get to your revenue goal. And two common scenarios that'll come from that is there'll be a cap on how much you can spend in that marketing, or you're going to run into diminishing returns. Not always, but those are pretty common. A cap example would be like if we're using that Angie's leads example. It's like, wow, I spent $1,000, I booked 10 grand. So I'm just going to spend 10 grand on that to get to my 100,000. But Angie Leads is like, well, hey, we just couldn't sell you $10,000 worth of leads. We don't have that much more. We only have like 20% more than we were already giving you. So you're kind of capped at a limit there. An example of diminishing returns would be maybe you're doing like a Facebook campaign and running ads on there. It's like, yeah, you can easily spend another 9 grand to bring it up to 10 grand, but you're not going to get the same ROI. It'll look like this, it'll be a curve like this to where you spent that first $1,000 and it got you $10,000 worth of work, but the next $10,000 you spend maybe only gets you $5,000 worth of work. So you have to continue to track. This thing is always evolving and changing, but you're gonna turn it up and put as much money into that marketing as you can to get to your goal. And when you do that, another likely situation is you realize you just don't have enough marketing avenues to help you get to your goal. So let's talk about what you do when you get there. All right, so if you find that there's not enough marketing things for you to do to stay within your budget and hit your goal, you're gonna have to make some changes. And it's usually not just like one change, it's a combination of things, but one change that you could do would be just to raise your prices. And I know that can be scary and maybe you're worried that you won't book as much, but you'll never know until you really try and test this. And to just keep it simple, let's say that you spend $12 and you book one job for $100. So that's where you get your 12%, right? Well, what if you raise the price of your job to $120? Now you spend $12, you still book that one job, but it was $120. So now you're back to that 10%. So that's how just something like even just changing what you charge can affect these numbers. Another thing is you're gonna look at all the marketing that was close to that 10% and make some changes and possibly try it again. Like with this Angie's List example, you look at it and you realize, where it seemed to break down was my lead conversion. Gave me a lot of leads, but I only converted 30%, where normally I convert like 60% of my leads. What change could I make that would maybe affect the lead conversion rate? So maybe you realize something like, well, I think what was happening is I was getting busy. I would get a lead, but I wouldn't call them for a couple of days, and by then they already had estimates and no longer wanted one. There's a bunch of different ways you could change your system so that doesn't happen. Like maybe you turn the leads off when you're busy and only have them on when you're not busy, or maybe you even hire somebody to attack those leads quickly, or just plan to make 10 minutes worth of phone calls every day and have like an alarm go off on your phone. Little things like that. I'm just giving a couple examples, but you're gonna make some changes and try it again and see if you can get it to the marketing percentage you want. So you might be thinking like, I see all these other businesses doing this marketing that just can't be profitable. How is that happening? And let me explain a scenario of how that would happen. Hopefully things go well, and as your painting business grows over the years, you're gonna get what I like to call sweat equity. So the easiest way to explain that is, let's say that you have 100 clients this year, and then next year, if you did absolutely nothing, those 100 people go to barbecues, talk to friends, aunts, uncles, that sort of thing that need painting. So you just naturally get another 30 clients based on that equity from the year before. And those 30 clients cost you no money in marketing. So if you just repeat that year, you did 100 clients with the 10,000 you spent. The next year, you do another 100 clients with the 10,000 you spent, but then you also get those extra 30 clients from your sweat equity. Well, now you have 130 clients, but you still spent the same amount on marketing. So what you'll notice is that like 10% dropped down to like 7.5%. So now with your plan, if it's still to spend 10% on marketing, you've got more money in the budget to market. So you can start doing some of those other marketing techniques that maybe weren't hitting the marketing budget you want, but you can afford to do that just depending on what your goals are. If your goal is to grow the company and get more sweat equity, then it would make sense to spend the money on that. Another nice side bonus is you'll owe less in taxes at the end of the year, but maybe you're in a year where it's like, no, I'm trying to save up for a house and I want to show as much income as I can to help me get the mortgage loan. So instead of spending that 2.5% on marketing, you're just going to pocket that as profit. My point with that is just explaining, like, depending on what your plan is and what your goals are is going to affect how you market. So to recap, the first thing with marketing is you need to make a plan and have something in place to track and measure and quantify your marketing strategies. Because if you don't have a plan, you don't do that, bad things can happen. Like I said, one of the biggest mistakes I see a lot of painting companies do is they don't track it. And it's like, hey, you're spending X amount of dollars on this marketing. How is that doing for you? How much work is that generating? And it's like, well, I don't know. It's like, you could just be throwing that money down the drain, that could be extra money that you could spend on a good marketing technique to grow your business or just put in your pocket as profit. Thanks for making it to the end of the video. If you like this content, consider subscribing. And if you think I did a good job, hit the like button or comment letting me know. So for making it to the end of the video, I want to give you a reward with some pro tips. So you're probably wondering, like, help me out. What kind of marketing should I do? If you're first starting, believe it or not, one of the best marketing things that you can do is go door to door. Now, I know that's not an answer that a lot of people like to hear, but for me, that's just how I did it. When I first started, 70% of my business was from door to door in those first few years. Now it makes up less than 5% of my business, but that took over a decade to get there. And to this day, we still run a little bit of door to door canvassing because it is that good. Now, some of the advantages of door to door is you can just hit the ground running. If you're trying to I'm going to build a website and, do search engine optimization, all this, that can take a long time to do. Where door to door, you can get leads tomorrow and book jobs tomorrow and be making money right away. It can be a little bit of a grind if you're trying to hire marketers and stuff, just with finding people, employing them, that sort of thing. But it is a lot easier to control door to door in terms of spending more or less money on it. If you want to spend more money on it, hire more people, give them more hours. But the door-to-door marketing should come out between 3 and 7% of your revenue. And it's almost always under 7. The reason I said 7 is because if you're first starting out and maybe not the best at it, to set good expectations, but it should definitely be under 7%, which is a really, really good ROI for marketing. If you're wondering what you say, just go through the neighborhood, say, hey, I'm such and such. I'm going to be painting some homes in here this summer, and I'd love to give you a free estimate. The more excitement and enthusiasm you have, the more effort you put into it, the more you show these homeowners that you want the work, the more leads you're probably going to get. You should be able to get at least 1 lead an hour. If you're not, you're doing something wrong or you're in the wrong neighborhood. We pay our marketers $20 an hour plus bonuses. We used to pay them 100% commission, but we found it was harder to hire. But we would pay $5 a lead, $10 an estimate, $15 for a book job. But we scratched that. We pay $20 an hour. And then sometimes we'll run different incentives and bonuses for them, like if they hit a certain goal or something like that. I use doorhangers.com, get my door hangers. If nobody answers the door, you hang a door. Usually about 1 out of 1,000, you'll get a phone call. So if you hang 1,000 flyers, you should probably get a phone call. If you don't, maybe change your flyer, mess around. And those leads are actually our best leads in terms of lead conversion and booking rate, or the door hanger calls. But don't plan on just hanging flyers. Knock on the door and actually ask. If you can give them a free estimate, if they say yes, don't give it to them right then and there. You're going to want to get their name, phone number, and write down their address. Call them later. Do a good job on the phone call setting up a winnable estimate. Then go out and do the estimate. And we've just had better success doing it that way than just dropping everything and doing the estimate right then and there on the spot. Now, the other pro tip I want to give you is, not always, but in my experience, it's a red flag when some kind of marketing strategy asks for a minimum, or they're like, well, you have to do it for at least a year. The example I like to give is when you go out to a restaurant, they don't say you have to buy 10 meals. You just have to buy the 1 meal because they know if the meal's good and you like it, you're going to come back. But you'll find with a lot of different marketing agencies and strategies that you can do, they're going to say, hey, you have to sign up for 6 months or a year. And in my experience, that usually means, again, not always, but usually, that it's a red flag. And it's because it doesn't work. That's why they're making you buy 12 months, because they know you'll cancel after a couple months. And they're going to have really good objection handling when they do their sales, and really good reasons on, well, you can't just do it for a month, you really have to put in the time. And what we found is with our other clients, it's usually in that 6 or 7 month when they really start seeing a ROI and yada yada yada. That's their job, that's what they're supposed to do. But like I said, in my experience, I would stay away from that when you're starting out. Save those for a little bit later when you've got some more capital to put to work. I would stick with ones where it's you can cancel at any time. All right, so I hope you enjoyed the video. See you in the next one.